Hello, everyone. Thank you for joining us for the New Capital webinar, Current Market Update. This is Catherine Barr, Director of Communications at New Capital. As usual, at the end of the webinar, we're going to have a Q&A session, so please feel free to use that Q&A tool for that purpose. Before we get started, I'm going to make the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Okay, thank you for your patience on that. And Leonard will be with you shortly. Thank you.
All right, so some company updates. First of all, our annual conference, everybody, is going to be on the 30th, and it's going to be virtual. So please put that on your calendars. Catherine, we're planning on like at 10:30 to 2 or so.
Yes.
Middle of the day again.
Yeah.
And we're going to send everybody is it Uber Eats or Grubhub? Or the
So everyone, in place, obviously we're having to make some modifications this year. Normally we provide a really great, hopefully everyone likes it, lunch buffet at the Hyatt. Since we're doing virtually webinar this year, along with any content, materials that go out for the presentations or for the day, we're also going to be sending food gift cards, and I believe it's going to be Grubhub or Uber Eats, one of those. So that we can still treat you well to lunch for the day of the webinar or of the conference, and you can use it that day or some other day for a special meal or something like that. But yeah, those will be coming in the day or the week, the days or week before the conference.
Okay, so please, I hope that everybody will be there. We may get bigger attendance than that. We usually get 40, 50 people or so, but may even be bigger this year because people don't have to travel. That'll be interesting. Working from home, just an update on that. New Capital continues to mostly work from home. We are taking meetings in the office. If you would like to meet with us in the office, we have a meeting with a client in the office tomorrow. Happy to meet with you in the office. As most of you know, I think as all of you know, our office is very spacious, and that's really proven to be a great thing during this pandemic, because we can give people plenty of room in the conference room and plenty of room in the sitting rooms and the lobbies and so on. And so if you would like to meet with us here, we are more than happy to do it. We've got a very good, strong protocol of masks and gloves and hand sanitizer and all that. If you want to meet, happy to meet. Also happy to meet virtually. I have been on several calls recently with Dimensional. They are going to be launching their own family of ETFs, 3 funds. You may know that ETF is an exchange traded fund. There are certain advantages with ETFs over mutual funds. There are certain advantages with mutual funds over ETFs. But I'll have more announcements on that, and it may have an impact on, say, smaller accounts where we can trade without a transaction fee at Fidelity or any other custodian. But I just wanted to let everybody know that that is in the works and is interesting. And then our internal software, NCM 360, I've talked before about the progress we've been making on that. This is software that maintains all of your financial information, and Catherine has been spearheading improvements and upgrades to that. And I think that we're going to reach a point later on, either at the end of this year or beginning of next year, where we would like to have some clients do some beta testing for us. So if you are interested in that, please shoot us a note, or you could even, I guess, send a little chat thing to Catherine right now. We're looking to get a handful of people who'd be willing to do some testing of the software for us. Okay, let's get right into some of the slides. So this is what the unemployment claims look like through, what is this through? This is from JP Morgan. So this is really not a super updated one. This goes through about end of July, I think. But you can see the trend is clear, that we have really fought our way back from this huge tsunami of jobless claims. And they dropped below for the first time since March recently. So we have an improving picture, and that's clear from this. But obviously, we're not out of the woods. How the pandemic shaped GDP projections, and of course, this is all over the world, that the pandemic has had an effect, not just on the health of people who live in these countries, but also on the economies. And you can see that Vanguard, and let me activate my writing thing, annotate and draw. All right, let's test it out. Test. Is it working? Test. Okay. So the base case and the projections that Vanguard came out with in 2019, when there was no hint of a pandemic, are these, this is what it was looking like, right? Here and here. And now the base case is here with downside to here, and even an upside projection, if we were to get a vaccine and so on, would still show a contraction. So this has been one of the worst economic contractions in history. No question about it. Emerging markets are, of course, not immune. Emerging markets, which have had more rapid growth estimates than developed countries have for a long time, even they are not immune, especially have not been immune. Brazil's an interesting case. The strong man there, Bolsonaro, recently decided to start paying Brazilians and giving them unemployment and assistance, and his popularity has actually gone way up as a result. It was way down. But you can see that 2020 growth projections for all of these different areas in the emerging world are down. And these are Vanguard and International Monetary Fund projections. A little better for 2020, right? So we see some improvement. And then the projection is that in 2021, these aqua-colored bubbles, we would see a return to pretty robust growth. I mean, take a look at that. That's a projection for 2021, 7% growth in emerging Asia. Overall, 6% for all of these countries. So the projections are that give it a year or two and we're going to see strong pre-pandemic type levels of growth. And that's important because we're invested in emerging markets. And there's a reason why we should be invested in emerging markets. And in fact, emerging markets have been the strongest asset class of performers for about the past 3 or 4 months or so. Don't know if you know that, but it's the case. Okay. Expected path of GDP across the US, Euro area, China, and the UK. And what we can see here is that this is interesting. China is actually predicted to return to its pre-pandemic level of GDP relatively soon, 1220, which is just in a few months. Not so the United States, right? Look, we still have this gap here. Not so the Euro area, same time frame as this Chinese inflection point. Not so United Kingdom, right? So we have, because of the failure of these countries, the developed countries here, to contain and control the virus, we have a lag that is not predicted to return to pre-pandemic levels, even by the end of 12/21. So very long-term impacts on the economies, but not so much in China. And the Chinese stock market has actually been a very strong performer this year. Don't know if anybody is aware of that, but it has been a good performer. These are scenarios that are put out by Vanguard, and upside surprises from that previous chart. What would an upside surprise be? Vaccine becomes widely available in early 2021. I think the news tonight is that the CDC is saying by the end of this year. But the politics of these announcements of vaccines have become so fraught, let's say, that it's very difficult to have any faith in what's coming out of a highly politicized CDC right now. So for Vanguard in early 2021, which means we go through the whole next year and there's no widely available vaccine, that would be an upside. New therapeutic treatments, antibody testing, closer to herd immunity than thought, but they only put a 15% probability on upsides, which means 85% of Vanguard's estimates, 50 here plus 35 here, are that we will not get an upside surprise. The baseline forecast, gradual staggered return to work, local virus recurrences by test, track, trace processes. I think the news this evening in the New York Times is an outbreak of 1,000 infections at the University of South Carolina? Did I see that tonight? Maybe somebody can throw a chat on. I think that's what I saw just before starting the webinar tonight. Consumers reticent about highly social activities. Certainly that continues to be the case, and an effective vaccine becomes available in late 2021. This is Vanguard's baseline. Downside risk they see with a very substantial 35% probability, premature rollback of social distancing measures. We've seen that. The virus returns and requires national shutdowns. Virus mutates into a more virulent form and vaccine development is delayed. So these are the different forecasts that our largest financial institutions are basing their estimates on. So when you see positive upside to GDP, you know, that's looking like this. But the baseline forecasts continue to be for very, very slow baseline growth. And Catherine, if anybody throws a chat thing in that that you want to drop in, that's fine. As we know, the COVID shock is having a varied impact on different sectors of the economy. So look at the different industries. So these industries are being more adversely affected. And what are they? Retail, transport and warehousing, arts, recreation, accommodation, and food. The persistence of the shock is going to last longer, meaning they're going to take longer to recover. And the impact on their industrial GDP is going to be higher. So that's a more negative impact. These industries, agriculture, mining and utilities, information technology, professional services, wholesale trade, and finance, including real estate, are not showing much negative impact, and the persistence of the shock will not be long. because of the ability to do what we're doing right now, which is to do virtual work. These are in the middle: healthcare, education, manufacturing, and construction. And I think that everybody has a good feel for this now very clearly as to how these industries have been impacted, both in terms of their market prices and in terms of our everyday ability as consumers to patronize these businesses. Clearly, it's still difficult to go out to restaurants, and it's not all that interesting or appetizing to go walk into retail stores unless it's something you absolutely need. But just sort of shopping for the sake of shopping is not something that people are too interested in doing. But I think what's important to note is that the majority of our businesses, right, the majority of our economy has held up. And that's a good reason for why stocks themselves have held up, because profits continue to be perceived by the market as available into the future. All right, so let's move and look at markets. You all were right initially in the question we asked about the dollar, and you can see that beginning around here, right? And this is year to date. So beginning sometime back around the beginning of the summer, we started to get what's been a pretty steep and precipitous fall in the value of the dollar. So, you know, from a peak of around $102 per, and this is a basket of trade partner currencies. So the euro and the yen and this particular index is showing the dollar against a basket of those currencies, and against a basket of that currency, you see we're approaching about a 10% down move in the dollar, and so that has implications for our exporting companies. That means that their products become cheaper to foreign buyers, and so it may have a positive impact on multinational companies, and it could in part account for the strength in those sectors of the US stock market, including technology. So the fall in the US dollar has had a beneficial impact on companies like Microsoft or Amazon or Coca-Cola or Pepsi, because their products are less expensive being sold in international markets. It also means that you as an investor, and the way we invest you globally, that you are getting an additional return from your international stocks, because in general, those returns are coming in foreign currencies versus your US dollar home currency. And so that's giving you an additional return in addition to the return that you get already from the stocks or bonds in foreign countries. So this weakening dollar, all in all, I would say, has had a beneficial impact for New Capital clients from an investment standpoint. The importance of staying invested, and I know that it was very, very difficult for a lot of people to stay steady back in March. The market hit bottom on March 23rd, but look what's happened since then. So here was the bottom on March the 23rd, and since March the 23rd, we've seen a almost well, this is through June 30th, so my slide is old. Even more, we're probably up around, I don't know, where's the mark? Probably up around 50% from the bottom of the market. So I'm sorry, I pulled a slide that's older than it should be, but you get the point. It has been the fastest, steepest recovery in the stock market, I believe, in history. I'm pretty sure about that. I think I can say that is a fact. And you can see that. Look at this deep chasm and then this very, very steep and quick rise. And so those people who bailed on the stock market right here, you know, I'm sorry, but that was not New Capital clients, I can tell you that. how does the COVID crash compare to other so-called crashes? Well, this chart shows that. You can see how here it is. This is the COVID chart. You can see how steep down and how quick it's like just a V that's gone on versus look at the financial crisis. This took, and this is business days since the shock. We've been 100 business days, 100 business days since the shock itself. In contrast, the global financial crisis was 400 days in the making to the trough, and another, right, out to here, another 900 days to full recovery. The tech bubble, which we're going to do some more talking about later in this call, because I know it's a big question. It's got to be a big question out there that everybody's thinking about. What about the technology stocks? So we'll take a look at that. Stick around. It was 800 days. Look at that. It was 800 days, 2.5 years of technology stocks falling apart. So I want everybody to think about that right now as we see, and I'm not going to say that it's a replay right now of what happened in 1999 and 2000. I'm not going to say that. The companies now are a lot bigger than they were and a lot more central and important. But we're going to talk about valuations, but I just want everybody to see that the tech bubble burst. And back then, you can remember, right? The internet's going to change the world. Everything's going to go internet. All right. At the time, there are important differences. The 10-year Treasury bond in 1999 and 2000 was trading at 5.5%. It's now trading at under 1%. So you had a place to go if you wanted to get out of technology stocks or stocks just in general. You had the risk-free 10-year Treasury bond that was trading at 5.5% yield. Now we don't have that. But I still want to point out, it was 800 days that it took for all the air to come out of the tech bubble. That was a painful, painful experience for a lot of people. And it took another, around 1400, took another 600 days for the tech market to recover from where it was. So this, you can see, this crisis that hit us in March with this pandemic and this really startling stock market recovery that has ensued looks nothing at all, does it? Nothing at all like the rest of this. Look at this, day after day after day after day after day of bear market, and then a long recovery. So I really liked this chart. Hopefully that makes clear what we have been dealing with here in 2020. Now, what do returns for the year look like for certain asset classes? Well, you've been hearing a lot about gold, right? And it has indeed up 26% year to date. And I'm also giving everybody here a 15-year column to compare. So you can see, okay, well, what's it done? And these are annualized numbers, right? So what is the average annual return? Gold's done pretty well over this period. 26% this year and almost 9.5% on average over the 15-year period. And it's been a really whopper of a period, right? With financial crisis after financial crisis and political crisis, and now a health crisis. The 20-year Treasury bond year to date, 21%. So those of you who have been totally focused on stocks this year, listen, bonds have done very well, and 7% a year is nothing to sneeze at over the 15-year period. U.S. stocks, everybody's focused on stocks right now, but they've done 9% in the aggregate, the market, since January. And they've done a 9.5% over the 15-year period, so pretty close to its 15-year average. U.S. bonds, 7% for the year. So if you're sitting here saying, Why did I hold bonds during this year in 2020? Well, 7% again is not anything to sneeze at. U.S. bonds have had a very strong year to date, far in excess of their 15-year historical periods. It's been a strong year for bonds in comparison to stocks, and it's been a strong year for bonds in comparison to its 15-year performance. Global bonds, 6.3%. Also a strong year for global bonds versus and very strong versus global bonds 15-year period. These are the conservative portfolio this year has outperformed the aggressive portfolio, 6.2%, and this is the whole year to date. And then the moderate portfolio, municipal bonds, 3.48%. That doesn't sound so great, but you know what? Muni bonds you don't have to pay tax on, so that's really more equivalent to a 5.5% pre-tax yield. So muni bonds have been a good performer this year. Emerging market stocks only 2% for the year. However, they've been very strong over the last 3 months. So they were very weak earlier in the year during the heat of the pandemic, which hopefully that is the last of the heat of the pandemic. Far below their 6.5% 15-year return, but they've been very strong lately. The aggressive portfolio from Morningstar's target risk ratings has been the least favorable performer among all these different ones. U.S. inflation remains muted, 0.5% year to date, but you know I continue to be concerned about it, well below the 1.85%, which itself is low. So we are in a period of muted inflation, but I continue to worry about inflation. International stocks, developed international stocks, down 5% year to date, far below the 4% on average. However, we're starting to see international stocks over the last months have done well. And you may have seen that Warren Buffett and Berkshire Hathaway made a $6.5 billion investment the other day in Japanese companies. And so he's no dummy. And I think that when he's looking for values outside the United States and looking to put cash to work in Japan, which has been very inexpensive for a long time, that's interesting. U.S. REITs, look at that. Commercial real estate in the United States, down 15% year to date. And that's not all sectors of U.S. commercial real estate, right? We know that offices and retail have not done well, but other areas have done well. Warehousing and industrial is really actually doing very well in U.S. commercial real estate as online commerce has taken off. Companies need additional warehousing, and that's the case. So I don't want everybody to paint with a broad brush exclusively in commercial real estate because they're different sectors. And look at commodities. I mean, oil has just had the stuffing knocked out of it, of course, earlier this year and remains low, down 30% year to date. Let me know if there are any questions about these return figures. This is the usual chart that I show. This is year-to-date performance, and of course, I'm sure everybody just wants to talk about this and this and this and this. Look at that. Look at these 5 big companies. 43% year-to-date Microsoft. Apple, 75% year-to-date. Amazon, 86% year-to-date. So what has happened? What has happened is that the pandemic has pulled the future forward into the present, and everyone has had to go virtual. Salesforce here, 66, not just the big guys, although Salesforce is big. NVIDIA, 127% as people have, Netflix, 63%. Home Depot, strong performance by Home Depot. People are fixing up their homes, right? What's everybody doing while they sit at home? They look around and they're like, well, I better go fix this and fix that. And look at the banks have struggled, and the energy sector has struggled. Utility sector, some struggle here. right? Not a bad picture in some of these others. Look at this diagnostic and research and medical. A little more muted in the large pharma. Not all tech has done well. Intel is down largely because Apple announced that they're going to make their own chips. Walmart, pretty good year so far, very good year for them. Coke down, Pepsi up a little bit. Anyway, but I want to break out of this here and show you some things using the same software here. So bear with me. Let's see, what do? I got to go clear the drawings and mouse, and let's see. All right. Okay, before I do that, let me just show you this. So this is a Citigroup, Citigroup chart. And this is the tech bubble. This is the Citigroup model for extreme bullishness. All right. And they are showing a panic. They have a panic euphoria model. This is euphoria, right? So when things go up, people are getting euphoric. And when they go down, we're in panic. So we were down here earlier this year in panic level, and now look where we are. So the Citigroup euphoria model is showing euphoria that is basically on par with the tech boom back in 99 and 2000. Look at that. And look how steep that was, where this climb took, that amount of time to go from panic levels in 94 up to, 6 years. Look at that, straight up like a rocket into euphoria. So it's a concern. Let's see if I want to do the next slide here. Same sort of thing JP Morgan is showing us here. And this date's only back to June 30th. We're going to get an update from JP, but same sort of thing here, right? So this is valuation, forward PE. What is the forward price to earning ratio? The higher the forward price to earning ratio, the more expensive stocks are. And so this is the tech bubble right here, very expensive. And you see here was this long working down by the market into inexpensive territory. And this was the financial crisis. And you can see now that we have been working our way back, and it is kind of culminating right here. I think it's culminating in a price to earnings ratio on the S&P 500 of 21.72, right? And this is also looking very much like these higher, more elevated valuations that occurred in this earlier period. So just another chart to give a sanity check. I like to look at multiple different sources. Are all areas of the market expensive? Well, let's look at that. Here is the S&P 500 growth sector, 31 times earnings. So those companies that are growth companies are trading at 31 times earnings. What does it mean when something's trading at 31 times earnings? What that means is that if there's no growth in the earnings, it will take 30 years for you to get your investment paid back from the earnings of the investment. That's a long time, right? 30 years. I'm not sure I'm going to be here in 30 years. I'll be 85. Mid-cap 400 growth. These are mid-cap companies in the U.S., 27 times earnings. So this is international growth companies, 26 times earnings. Small companies in the United States, 21 times earnings. Value companies in the S&P 500, 19 times earnings. Value companies in mid-cap in the U.S., 14 times earnings. Small companies in the U.S., 13 times earnings, and small company or in value companies in international, 12 times earnings. So you can see these are much cheaper than these growth areas of the market. Everybody's chasing growth. Everybody wants growth, right? And they are really paying up for it. Well, what has growth versus value done historically? Well, this is from 1920 1928 through 2019, and these are years where value beat growth. When the arrow is green, or when the bar is green, that year value beat growth. When the bar is teal, growth beat value. And you can see we've had a whole series of years here, 3 years or so, where growth has beaten value. But look at the history going back. Long history. You can see that most of the bars, or a majority of the bars, are green, bright green, lime green, and that means that in most of the years since 1928, value has beaten growth, and on average by 4.5%. So we have to keep that in mind. We have to keep in mind that this is market history. I want to show you just let's see. These are Vanguard's projections. So let me talk about those. What does it mean going forward? Where these are Vanguard's current projections. U.S. equities, they are projecting returns from 4 to 6%. U.S. value, they expect to be from 5 to 7%. Look at U.S. growth. Look at because the value of growth stocks has been bid up so much that they're now only projecting 1.5 to 3.5% would be the projected returns for growth companies in the United States. Large companies, call it almost 4 to 6. Small companies, 4 to 6. Real estate investment trusts, much muted. Global equities, unhedged. So Vanguard is seeing greater opportunity out of the United States than in the U.S., 7.5 to 9.5%. So if you want to get your 10% in the market, you're almost going to have to own equities outside the United States. And they also have a muted projection for inflation. Look at the bond side of things, right? I mean, on the low side, under 1%, under 1%, 1.5%, 0.5%, 0.5%. Emerging markets, 3% on the low side, 4% on the high side for the bonds, and U.S. high yield, 3 and 4%. But the investment grade side of the market in bonds, you'll be lucky to get 2%. So to get higher returns, it's going to force us all into these sectors of the market. Global equities, international diversification. If Vanguard's projections hold up. Okay. Before I get to elections and markets, I want to break out of this real quick and just show you. Actually, I'm not going to do it. We're going to stay on time here tonight. And if in the Q&A people want to see more on valuation and more on stock valuations, I'll be happy to show it to you. But let me stick with the slides right now. Okay. Let's talk about elections and markets, because I've been getting a lot of questions about that from people lately. So let me take this opportunity to talk about it a little bit. Annual compound return for a Democratic president over 65 periods, 8.4% has been the return. Annual compound return for a Republican president over 94 periods, 8.2%. These are virtually statistically indistinguishable. No statistical difference between these. All right. So that's the history. And you can see most of the time it's positive, right? We obviously have down years in the market, but obviously most times, 3 out of 4 times, the market has returned positive returns, and it's been virtually indistinguishable between Democratic and Republican presidents on a statistical basis. I would note that more recently, we do see some steeper falls under Republican presidents, right? So I don't know if that says anything, but these crises have occurred generally more often under Republican presidents. All right. This slide is showing us that U.S. stock performance from 1926 to 2019, all years, 10.1%. What about during election years? What happens? Well, during election years, we actually have a little bit of a higher return over all years, historically, 11.3%. Midterms actually deliver lower returns than average. And non-election years, no midterm or presidential elections, right? Odd years, as it were, actually show the highest. But, you know, we're not showing markets that totally fall apart because we have an election or we don't have an election. U.S. stock performance has been largely positive with a noticeable drop against average returns during midterms. Okay, this slide shows that during election years, it's not uncommon for investors to hold more cash. And a lot of new capital clients are holding more cash right now. It's perfectly fine. And it's perfectly normal. So in a presidential election year, money funds tend to be held in greater quantity than in a non-presidential election year, right? And in a presidential election year, people tend to cut back on their stock and bond funds versus in a non-election year, non-presidential election year. And this year, in 2020, we've had very large flows into money market funds, money funds, cash funds, and we've actually had net outflows. This is through June 30th. These are BlackRock slides, by the way. We'll see where things are as of September 30th. I have a feeling with the stock market roaring that a lot of this cash is coming off the sidelines and driving those stock gains. Okay, just a few random thoughts, and then we'll take Q&A. As I said, the effect of the virus has been to bring the future forward. We've heard for years about people are going to work from home, and kids are going to do school from home, and people are going to shop online, and you know, you're going to not go to the movie theater anymore in the cinema, and on and on and on. Well, that future has arrived. it of course was completely and totally accelerated by the pandemic. So in many ways, it's not that the future got weirder or got unthinkable. It's that the future got close to us and arrived sooner than we thought it would. And that's why we're seeing a lot of increase in valuations and profits for a lot of companies that are involved in sort of future-based businesses, because the virus brought all the profits and so on forward. So I'd like everybody to sort of think about it that way. That's what's happened. Now, at a certain point, that's already in stock prices and that's already in profits. And once the future is brought forward like that, that means we may see a fall off later on, because we're not going to see the sort of rapid growth, because future growth has already arrived. So I think that's a concern everybody should be thinking about if they think stocks are going to just roar ahead forever. In some ways, profits and market caps have simply been accelerated forward. The issue of fiscal stimulus continues in Washington as to whether we are going to see the government continue aid that was originally issued back in March, especially to small businesses. Very big issue and a very big risk factor. We don't know right now whether politically the Republicans and the Democrats are going to issue additional financial aid to those in need in the country. So, of course, this bears watching. Political risk. We don't know what it's going to look like if our democracy, I don't want to say goes by the boards in November, but whether ongoing indications continue to emerge that the thing that underpins so much of our system, a legal system that operates to protect shareholders, um, and other aspects of our political system will remain intact past the November election. So the biggest risk that we face right now in many ways is political risk. Another reason why international diversification is advised, because in many cases we have in foreign countries and international countries now stronger, more reliable, and more well-designed democracies than we do here in the United States. The United States democracy here needs a significant renovation, and it's unclear whether we're going to get it. And I want everybody to be very careful about their own greed factor right now as we see certain companies' valuations soar. As Warren Buffett says, it's best in investing to be greedy when others are fearful and fearful when others are greedy. And I am starting to see greedy type behavior among segments of the investing public. And that's a concern to me. I want to make sure that new capital clients keep their heads on straight. And the thing that will take your head off faster than anything is greed. So if you feel your greed coming on and you want to talk about it, let's talk about it and we'll see what we can do. At the same time, if you feel like there's some part of the market that you want to participate in with some part of your money, happy to do it. Some clients have asked for that, and I've got funds that we can certainly take a look at that might meet your needs. I just want to make sure we control for risk because we don't know when risk is going to blow up again. Okay, that does it, I think. I'm going to stop right here. I think I'm running pretty good on time, 6:53, and we've got a few minutes to take some Q&A. So let me stop there. Catherine, take it away. What do I do? Do I stop sharing or?
No, go ahead and if you want to just flip to the last page, you can.
Okay. All right. There it is. I like that. I like that slide.
Yeah, it's nice and nice.
That's a good slide.
Okay, so we've got a few questions that have already come in. Excuse me. And we'll go ahead and ask those. I'm also going to share the link for the evaluation survey. So before you jump off, if everyone wouldn't mind, I don't know if that came through as a hyperlink. I'm going to try it twice. If you don't mind following that link and answering that evaluation survey, we would greatly appreciate it.
Yeah, we like to know how we do and whether this is good. Always, we want to know if what we're doing is valuable to you and helpful to you.
So we've got 4 questions that came in during the presentation. Also, feel free to continue typing in while we're chatting, and we will try to get to all of them. The first question came in, it was early on in the presentation, but it says, if there is so much turmoil, pandemic, racism, unemployment, why is the market doing so well? You may have touched on that.
It's doing well because the market runs on profits. Number one, the market runs on profits, and the profits it runs on are future profits. Past profits don't mean anything in valuing stocks. It runs on future profits. And so despite the problems, companies continue to do business. They continue to make products and provide services, and they do all over the world. And in many cases, the pandemic has caused some businesses to actually experience growth. So that's why the stock market is doing well. That's number one. Number two, the alternative to stocks has usually been bonds, and they're not extremely appetizing from a return standpoint. They have value as a safe haven. They have value as a way to dampen volatility in a portfolio. But they don't promise much in the way of returns, as I showed you in that slide from Vanguard's projections, 1 to 2%. So that's pushing people out into risk, into take more risk. And they're paying up more and more and more for company shares And at some point, they're way overpaying. So we have to be careful about that. I hope that answers the question.
This, I believe, is a follow-up to that. So how do you damper portfolio to balance risk of equities?
With bonds and with value stocks. With bonds, with international stocks, and with value stocks. Because international stocks are cheaper, significantly so, substantially so, let me say that. Value stocks are cheaper, significantly so. I showed you the PE ratios. And again, I admit we don't know where earnings are. You know, if you ask me what are the, if we look at the banks, whatever, JP Morgan Chase, you know, I'll say I agree. I don't know exactly where their profitability picture is going to be, or if it's retail. I don't know where the gap is going to be nearly as much as we can see where, say, Apple is going to be with the new iPhone. But still, even with growth projections, those companies are trading much more cheaply. And this investing has always been and always will be about the price you pay for the investment. It has to be, or the system's completely broken. It just has to be. Okay.
Okay, next question. The Republicans appear to do a much better job of selling that the market is better under their administration versus Democrats. Many believe less regulation, like Republicans, are better for companies and the market. I guess the question is why, since the facts don't seem to support that.
No, I showed you some slides. The facts don't support that. So my own speculation is that either one, facts don't matter, and we're certainly in a period where for a lot of people facts don't matter. But it could be that a lot of things that get said to cover for other reasons for supporting people politically, right? So there may be other reasons that people want to vote for something, and so they'll come up with something like, oh, they're better for whatever, even though there's no evidence that they're better for that. But there is no evidence that Republicans are better for the stock market than for Democrats. And as I showed you in the slide, under presidential administrations that have most recently been Republican, we've seen steeper declines more regularly in the stock market than under Democrats. That doesn't mean that that'll be the case going forward, but that's what the recent history has been.
Okay. Next, I have read speculation that the U.S. Treasury and Steve Mnuchin, has been using taxpayers' money to buy a lot up to $1 trillion of corporate bonds and maybe stocks in order to prop up the stock market before the election. Is there any truth to this?
I don't know about the Treasury buying corporate bonds. I'd like to see that piece. I have heard about the Treasury making injections into companies, and maybe that's coming through bond purchases. There was a lot of controversy about the sort of slush fund that Mnuchin was given back under the emergency legislation back in March. I frankly haven't heard a lot about what's become of that and whether there have been able to successfully be any efforts by solicitor generals and others who would be investigator generals who would be looking into Treasury. So I don't know the answer to that. It is for sure the case that the Federal Reserve has expanded the scope of its bond buying. No question about it. I can say absolutely the Federal Reserve has expanded it, including into purchases of high yield corporate bonds. So I don't know that Steve Mnuchin needs the Treasury to do that. The Federal Reserve has been happy, especially back in the March-April time period, to put a floor under bond prices. I don't think there's a lot of that going on right now, and they may be unwinding that trade. I wouldn't be surprised if the Fed is unwinding that trade. I don't think it's a place the Fed wants to be, buying corporate bonds. I think they really don't want to be there for a long term, but I think that given the magnitude of the dislocation that occurred back in March, the Fed looked at it and said that they needed to step in to put a floor under corporate bond prices. I don't know about the Treasury, but if you've got, whoever asked the question, if you've got something, I'd like to see it for sure.
Okay,
Anything else?
Yeah, there's two more. This next one's not so much of a question, or maybe just to get your opinion. It says, you mentioned the election in November. It's important to realize that is very, very likely we will not know who won the election that night, especially if voting counts are close. It may take 2 to 3 weeks to count all absentee and mail-in votes to get a true count. Experts are warning that the public needs to be aware of this now.
Yes, I agree wholeheartedly. I wholeheartedly agree. And at this point, is it the Chinese who say, "May you live in interesting times"? I think it is. It's a Chinese saying, "May you live in interesting times." We are living in interesting times, and this will be an interesting election, and it will be an interesting election the day after, which is my birthday. So I'm hoping that I get a birthday present and I don't have to like wait for a birthday present for 3 weeks. I'm just going to say that. Okay. What else? Anything else? Any other questions or concerns?
There's one question that's already come in, and feel free to ask more if you have them. The last one that we have as of right now is, consumer spending has been historically a driver of our U.S. economy. Do you see the continuing pandemic effects, retail, dining, entertainment, trips to the mall, et cetera, chilling the markets?
The market has already discounted retail stocks and consumer spending related stocks. Amazon, although, is a consumer spending stock and it's done just fine. So not just fine, it's up 80, I showed you, up 86% year to date. The United States, in my view, has been over-retailed, including in the restaurant sector, for a long time. And I said this back in March. I think some people were sort of like taken aback by it, but we've had a lot of stores that sell lots of stuff, and a lot of malls and a lot of strip centers, and in those places they sell clothing and shoes and athletic apparel and food and prepared food. And in some ways, there's just been too much of it. And we sort of see that now in the pandemic as people are doing more cooking at home. It's like, God, it's a lot of restaurants that are out there. I don't know what happens to the US economy and a lot of those people, because I don't know what happens in the election. What I can say is that the United States has many, many opportunities to do some renovation. And I think that a lot of jobs that would be involved in those renovations, so-called infrastructure, would pay better than a lot of the jobs that have been in retail and food services. So I think that is a big question as to how the election comes out. I think the Democratic Party is far more inclined to pull the trigger on a big infrastructure rebuild that would rebuild the sectors of the country that really, really need it. And I think that would be good for people who have been working in lower paying retail jobs. But I'll also say that the Republican Party seems to have gotten with spending, because they've been willing to spend too. What they're willing to spend on that, I can't answer. So I think this question of consumer spending, retail, et cetera, really does depend on the election and how it comes out. But I can see a path forward that's very highly optimistic for people who've been working in those industries, where they would take different jobs and retrain and be doing things that would be part of what would be a great American renovation. Right now, people are renovating their homes, and I mean, they're really doing it. I was at Home Depot today, and I mean, it's it's full on as people are fixing. Catherine, you're fixing your home up, aren't you?
Yeah, we're in the middle of a complete bathroom renovation, like building a shower. We're in the tiling phase, so we're almost done. But it's been at least the length of the pandemic. So it's taking a little while, but we're at Home Depot and keeping the economy going.
Not too much, though.
Too much.
Too much. So, but you know, that's going to come to a close. That period of the pandemic is going to come to a close as people, right? I mean, you're going to finish we can only fix our home so much, right? Everybody, it's a little much after a while, and it just, so that period of the pandemic of home fixing and home renovation is going to come to an end. My view is that it's then going to be time to fix the country in so many, many different ways, including our electoral systems, our systems of governance. The executive branch needs to be reformed. The legislative branch needs to be reformed. The judicial branch needs to be reformed. State and local governments need to be reformed. And our infrastructure needs to be reformed. That's a lot of reform. And the good news is those will be good jobs. So somebody who was, you know, in the sort of trite thing to say is flipping burgers, but somebody who was flipping burgers may be laying track, pouring concrete. And I think that would be just fine with them and with the country. So anything else?
There's no other questions that came in. If you all have any questions about the content or anything, anything else at all, please feel free to contact us after the webinar and anytime. And we'll be sharing a recording of the webinar next week. Actually, we're hoping to get it out this week, so look for that in the journal. And that's it. Leonard, if you want to close it out.
I just want to say thank you to all. We had a smaller group tonight. That's perfectly fine. I'm one person's good with me. So it's been great to be with you all. Our next time to be together will be the conference on October the 30th, and I look forward to that. And in the meantime, if anybody wants to meet, whether that's in person or over video or even a phone call or even an email exchange, happy to do all of that. So thank you very much for spending time with us this evening. And Catherine, thank you for working hard as usual to put it all together for us. You do a fantastic job for our clients putting these webinars together. And all I have to do is just walk in and put the headphones on and it's all ready to go. So thank you. Okay, everybody, take care.